call to order. Mention for meeting, roll call.
Larry Lee,
Here.
Troy Cruz,
Here.
Gar Nettles here. Parks absent.
I can get you.
Okay.
Yeah.
Want to review and approve minutes of the August 13th. meeting. Do we have a motion to approve?
I make a motion to put them on.
A second.
All in favor? Aye. All right, Mr. Bauer.
Well, good morning.
Good morning.
Not exactly sure where she wants me or how this is gonna work.
Well, we're recording the meeting, so if you use the microphone, that will make it record better.
All right,
But the power button on top, just press that until the light
I've
comes
got
on.
that, but again, the camera.
I can move the camera.
Huh?
I can move it. You're backwards, but you're on there. See the button right on top? I'll get it for you.
Anyway,
I don't know, do you want this camera or do you have a phone?
Well, I should face the audience, so it's that,
Yeah. It'll be the back of you on the camera, but that's.
well, that's not a great shot.
That's my best side.
All right, well, good morning, everybody. This was not our best year. This was difficult for a couple of reasons. Obviously, it was very volatile. We started out first quarter quite strong. It looked like we're going to be getting the year with a nice recovery in the economy. A lot of the stocks that you would associate with recovery, like industrials, financials, started to go up in January, early February, and then the pandemic kind of bubbled down everything. And it turned everything upside down. Obviously, everybody said, well, gosh, with this pandemic, we're not going to have an economic recovery. We're probably going to go into the soup to a degree. And the stocks that everybody moved to were some of the old growth names. Microsoft, Amazon, Google, Facebook, some of those that would do well during this period. Now, they were already expensive, but everybody plowed into them and made them even more expensive. In fact, they've gotten to be quite expensive. In March, we took a real tumble in the market, as you probably recall, and we made some changes. We realized too that we had to have some of these stocks if we were going to have any performance whatsoever. So we added Amazon, we added Facebook, we already had Google, we already had Microsoft. But the handful of those big cap stocks became such a big proportion of the S&P 500, it became 40%, that it drove the returns of the S&P 500. We can't have the same proportion or the same weightings of those companies that are in the S&P 500. We're guided by fiduciary responsibility toward the account and prudent man rule. So we have to maintain a fully diversified portfolio. Some of these weightings of the S&P are 8, 9, 10, 11+%. We can't have that kind of a weighting. So we have a more diversified portfolio. So we like the S&P, but that's just all there is to it. And that's going to happen from year to year, from time to time, I should say. So at any rate, we did make some shifts. And now it looks like, now that we have some vaccines on the horizon, there's a shift almost back to those companies that will do better when the economy opens up once again. The industrials, the financials, business cycle sensitive companies. So we're having a lot of back and forth. And we're in that period right now where it seems to be going back and forth every few days. So we maintain kind of a balance right now. But at some point, we're going to have to lower our proportion of the old growth companies. They're expensive. They're not going to go much higher from here. And we're going to have to move more toward those companies that benefit from the economy improving. But in the meantime, we're going to go through kind of a little rough period, more than likely. These vaccines won't be out for a while, and it will take some time before we have enough people inoculated that it makes a difference and that people are out and about and we approach normality once again. In the meantime, we haven't had additional fiscal stimulus, which means people that lost their jobs because they were waiters in restaurants, or they worked in hotels, or they worked in the travel and leisure industry, that money's run out. So we could go through a little bit of a rough period here. So that's why we're maintaining the balance. But I'll get into the nitty-gritty here. If you'll turn over to the first page and you see up at the top, look down toward the middle to the left, you'll see we started the year at 11.215 million. Does everybody see that? On 9/30/2019, that's the end of the previous fiscal year. And down the bottom, you see the market value at the end of this period is 11,635. Everybody see that? About 306,000 came out. You know, their distributions every month. You see our fees there, and you see some expenses there. They're fairly minor. You see that we gained about 177.5 in income. The appreciation was about 630,000, 631 almost. And then there was a slight change in accrued interest on the bonds. And that adds up to where we ended up. If you look over to the right, you can kind of see a tabulation of the values over the last 10 years. You see 10 years ago, in 2009, the account was worth a little under 6 million. And here it's worth a little under 12 million. It's gained about 9.4% when you include the ins and outs of this account over that period of time. So it's done quite well. This is just a year that was a little bit difficult for us. If you go to turn the page over, you will see that for the fiscal year to date, we were up 6.51. The S&P, this 70/30, said we should have been up 13.66. That's quite a bit difference. But that's those high value, high tech companies that did so well in very high proportion. We have some of them, but we can't hold them at 8, 9, 10%. In fact, a handful of companies make up 40% of the S&P 500. Now, Blake can have much more diversification where we have one portfolio here. And it's done very well. It's just not the best year we had. If you turn over, you can see where we are. At the end of the quarter, we had quite a bit of cash. Right now, rates are so low that for a relatively short piece of paper, you don't get any difference what you're going to get for 1, 2, 3 years than you do for just having it in the money market fund. It's pitifully low. We started the year thinking that 2% was extremely low, and then it went down to 0.6. Now, that's not something you invest for. We're not going to take those kind of risks. If you don't think there's inflation coming, you're not looking out there very much. Healthcare costs. God, you in the construction or the building arena, you see it every day. I mean, things have gone crazy. Housing prices, land prices,
Materials.
all kinds of material prices, lumber's tripled. Some of that is just the good times, but it's affecting a lot of other things. If you shop for groceries periodically, you've noticed that a basket of groceries has certainly gone up. And so it's out there and it's coming. We put a lot of money into the system. Once things get back to normal, I think there's going to be a lot of pressure on prices. So we're very careful about committing to interest rates, especially at these low levels. But anyway, we've got a number of CDs and bonds. You can see the whole schedule. You see the first one up there is a Bank of America. It's 1.8% maturing October 8th of 2020, so it's already matured. We have another one, Goldman Sachs, and we got another one in October. Here's a November 9th, the Wells Fargo that just matured. So we have a schedule maturing and they go out to 2023. You see the Morgan Stanley bond out the bottom. That's a 2.85%. We can't get those rates right now. And those are still typically low. You know, you have an actuarial assumption of somewhere around 7.5, 7.75. And you load 30–40% of the portfolio up with 2-something%, it's a pretty big drag to overcome to get to your 7.5, 7.75 for your actuarial assumption. But we're not the only ones that, you know, the whole industry is challenged by that right now. Then we get over to the equities, and under communication services, this is a relatively new category. These companies, there's a couple of them used to be categorized under technology, and they split out a little over a year ago, was it Blake? This communication services sector. And so Walt Disney and Facebook and Alphabet, which is Google, all follow under this. And this has been a very strong category. Consumer discretionary, well, you would think Amazon might be a technology, but it's a consumer discretionary thing. And that was added, and that's off to, you know, we had a very good run on that. We bought that at a very opportune time back in March, April. Garmin we've had, Lowe's we've had, Target we've had, Ulta Beauty we've had. Then on Staples, nothing's really changed here. We've had all these names all along. In financials, we switched Citigroup for Bank of America. Citigroup reported some earnings the last quarter, and it became quite apparent that their problems were deeper than we had anticipated. So we got to a stronger bank. I think Bank of America doesn't have nearly as many of those issues and will come back stronger. So we just made a switch. Goldman Sachs, JP Morgan, MSCI we've had. Healthcare. Healthcare really didn't do much last year. You would think with the pandemic and all the talk about healthcare, a lot of these companies would have done very well, but they didn't. I think there's a little bit worries about price controls. We don't think that's going to happen because we don't think Congress is going to allow real strong price controls. But that kind of has held them back. These companies are actually doing very well. Abbott Labs, I mean, they're providing a lot of the tests. If you've had to take any tests, you may have taken an Abbott Labs test, the quick tests they came out with. But their strong suit is in diabetes. They came out with that device that has a little sending unit that you might put on the back of your arm, and you can read what your blood sugar is, or happens to be at any given time on your phone. Align is Invisalign. That got hurt during the downturn, but it seems like everybody wants to go and get their teeth straightened out now since they're sitting at home. And they're doing very well. Edwards is, their big product area is artificial valves, which they, like the aortic valve that can be actually replaced by basically threading it through your veins. Illumina is DNA testing. Intuitive Surgical is robotic surgery, and that's taking the place of a lot of surgery. Merck, you know them, Mylan is now changed. It was recently merged with a company, a spin out from Pfizer called Upjohn. You've probably heard of Upjohn. They formed a new company called Viatris. We think that this is going to be a much better organization and has different management. So we decided to stick with it. Teleflex is new. They do a lot of consumables for, say, operations. They also are big in a particular procedure called UroLift. That is very important for older men, when they have an enlarged prostate, it basically is like they go in and they open up the prostate mechanically with, I call it a rivet. It's not a rivet, but it's like that. But they go through the urethra and they can actually open up that pathway, and it's taking that particular market by storm, doing very well. And Vertex is big in cystic fibrosis. They kind of own that market. Industrials, we've got a good number of industrials. Amatec we've had for a while. Clean Harbors was added this past year. It does a lot of environmental companies, but also some basic industrials. One that you might know of or ran into is Safety Clean. If you've ever been around a mechanic shop, you know what Safety Clean is. Deere was added, John Deere. It looks like the agricultural arena is finally coming around and doing very well. There's been a kind of a lull in the replacement cycle for agricultural equipment, and now it's picking up. You know, every 5-6 years or so, equipment wears out, and there seems to be a cycle as to when you replace them. Emerson was added. Graco we've had, Honeywell we've had. Then on the technologies, we've gone ahead and removed Fortinet since this report. It just didn't work out. It's a fine company, but there's a lot of competition in their arena, which is basically cloud security. And they didn't look like they were going to be the ones that really emerged at the top. So we decided to change them. And then in materials, we've got FMC.
Do we pick up anybody up? That's the Fortinet.
Yeah, we picked up Parker Hannifin, which is a industrial equipment company. And we picked up Southern Copper, which is a materials company. And they have copper mines mostly in the Western Hemisphere, a lot of them in South America. And copper has really come up. It was under $2 a pound. It's now over $3. And with all the building all around the world, but especially China is a big user of copper, looks like they're in for several good years. I put together, this is the one-sheeter we call it. This is since the end of the fiscal year through this past Friday. The accounts now, if you look at the middle, they're up to about 12.189 million. Everybody see that? So this short period of time, it's gained about 5.8%. I don't know how the year will end up, but certainly since the beginning of this new fiscal year, we have the election that kind of stalled things. And since the election, the economy or the market has done quite well. Everybody fears for the worst, but actually it's done quite well. There were a lot of announcements on vaccines. 3 companies now have announced that they have something basically almost ready to ship. And that's given a lot of confidence to the belief that we're going to get past this. And that helped. So we're off to a fine start and well ahead of the indices. But last year was just a year where it didn't meet our style. If we could have concentrated, it would have been a different story, but it wouldn't have been appropriate, certainly for a pension account.
Does that cause people to run out and try to buy that stock in those companies, the pharmaceuticals with the vaccine?
Well, it has. I mean, the companies like, not Pfizer, because it's such a big company, but BioNTech, that's part of them that's gone up. And then the other one, what's the other one that just announced? AstraZeneca just announced, looks like it's going to be very inexpensive to produce. So it looks like it could be widely distributed. And then we have our own mRNA company, the name escapes me right now.
Yeah.
But it announced two.
But is that typically something that doesn't last long enough to run there, try to get involved in that?
Yeah, I would.
And
these are both of those are very small companies.
Mhm.
In both cases, this is the first basic product that they've come out with that is marketable. So it's a very narrow product range. And how much money they're gonna make all of it, I don't know.
Because the government's probably gonna limit their profits, right?
So, you know, it's wonderful that they've done it,
Right,
and it's certainly decent for their company, but not as big as everybody might think.
okay,
And they've got to build a lot of other products for them to be really viable long-term companies. There are going to be a number of other vaccines that come to the market here yet. So it'll be a fairly diversified group of providers, which is also good because a lot of different approaches mean if, you know, little changes happen, you know, you have a better chance of really controlling this virus. And there's 7.5 billion people out there. It's going to take an awful lot of capacity out there to really knock this down and keep it down. You don't want it popping up here, there, and everywhere, and then mutating and then coming back as a slight mutation. It's like, you know, we pretty much conquered polio, but unfortunately, there's still a few countries where it pops up now and then. And you don't want it to mutate and then get to other places where, you know, people have been lax, they're not taking the polio vaccines, and you don't want an outbreak. Measles is another one. So, you know, you've got to really be vigilant about these things. But anyways, the account's in good shape, a little over 12 billion now. 10 years ago, it was a little under 6. It's been quite a 10 years, and a fairly volatile 10 years as well. With that, I'll let.
Thank you, Peter.
yes, thank you.
Next up. Again, guys, good morning, and thanks for taking the time to review the plan in a little bit more detail. As Peter said, I'll try not to reiterate what he said, but a couple of things we're pointing out. One, it was a very difficult year. You had to have a lot of large cap growth stocks and technology specifically, and you had to have a handful of them. The category has several names, but really it was 5, 10 names that drove the performance of the entire Russell 1000 growth, which was by far the best performer. So we did a little bit better, I think, on an absolute basis, but still probably played a little bit of catch up because of, you know, again, the dominance was so concentrated in just one particular sector. While we do have, you know, a big chunk of the plan there, it is very, very difficult and nearly impossible from a fiduciary perspective to have overweighted Apple last year. We would have had to have 12, 13, 14% of the fund in it, and no, you know, institutional manager is going to feel comfortable taking that big bet on any company, no matter how big they are. And you could argue that the merits of Apple going forward, but so again, that really kind of drove a lot of the return. To kind of put it in perspective, over on page 4, you've got the scorecard, what I call the scorecard of the performance numbers through September. And down on the bottom, on the left-hand side, we look at the various styles and growth versus value. Again, we have even a very well diversified portfolio, but look at the blue box specifically. When we break down the U.S. market, large, medium, small, growth, value, and put a core or blend in the middle there. But look at how much better the growth style did in large cap, 24.33% versus the 1,000 largest value companies, off over 11.5%. That 35% or so difference is really historically at an extreme. We're starting to see a little bit of a rotation back where the value names do a little bit better. And if we look at the sectors of the S&P 500, that bar chart right next to it, you'll see energy and financials, the 2 worst performers over the last year. Both of those make up nearly half of all the value indexes. So again, it really mattered where you were. You wanted to be in growth, and you wanted to be in the big growth companies. Otherwise, you had a tough time keeping up with benchmarks. And but from an absolute perspective, again, very, very pleased with how the portfolio performed this year. Really very pleased on how fast it's come back over the last 6 months. I mean, standing here at the end of March, there was no way I would be thought I'd be showing you a number that didn't have a dash in front of it for a fiscal year return. And very, very pleasantly surprised that not only did we get that, we beat our actual assumption again this year, despite everything that's going on. And again, I think that's really just short of remarkable on how well the portfolio has done in the environment that we've seen. But just to kind of, go through the quarter in a little bit more detail, back up on that table on the top left-hand side, we've got all the major market indexes. The S&P 500 was off a little bit for the month of September, but still up almost 9% for the quarter. Saw, kind of a continuation of what we saw in the second quarter. That rebound just kept going, especially in July and August. That left us up about 5.5%, and we've certainly added to that from here. As we sit here today, the 2020 return is a lot closer to 10 or 11% than 5.5 that I'm showing here at the end of September. It really has, after kind of a flat October, we really, since the elections, or at least that Saturday when the election was officially declared over, well, it's not certainly over, we think it is, but we got the vaccine news the very next Monday, and we've been kind of running ever since. Pretty broad-based rally too, as far as other equity asset classes. But again, international has been kind of a drag so far this year. If you go to that third row, you'll see the MSCI EAFE up almost 5% for the quarter, but that's still left international stocks off over 7%. So again, kind of matters where we're picking. We've been underweight international, and that certainly benefited the portfolio. The other area that's done extremely well, as you might imagine, is bonds. Again, nobody saw the pandemic really coming as hard as it came, and the biggest beneficiary time and time again has been U.S. Treasuries. We've seen kind of an unwinding of that, where Treasuries are starting to lag over the last couple of quarters as more of the the investment grade bonds and sub-investment grade corporate paper does a little bit better. But again, those were the hardest hit, and they're still kind of playing catch up. But to give you an idea what bonds did, they were essentially flat. They were up about 0.5% or 62 basis points for the quarter. So not a whole lot of income there. And then for the year, they're up almost 7% or 6.79 to be specific. Just touch on our current strategy over on page 5, and not a whole lot has changed since we got together last time. We still like stocks a little bit more than bonds. Again, with rates at 0, we're not getting compensated to hold any kind of weighting there. So we're kind of underweight fixed income. Within stocks, we still like those U.S. and large cap specifically more than any others. And then we do have a slight growth bias in the portfolio. Again, that certainly helped us a little bit over the last couple of quarters. We're starting to see a bit of a rotation back to value now, but at least for the time being, we think the growth style should continue with its momentum and do a little bit better. And then again, on the bond side, we're trying to minimize treasuries because they've already had their pop. And again, the yields there are so low. Same is true with mortgages. With interest rates at 0 levels and mortgages at all-time lows, there's really not a whole lot of extra income to add there. So we do like high yield as corporate bonds specifically. So
Blake, what happens is the small caps, are they tied to the stuff that got hit bad by COVID, or what's the deal there?
By the very nature of the companies being a little bit smaller, they're a little bit more volatile. There's a little bit more risk associated with it. Always have, right? Because the chances of them not being able to weather a recession are a lot higher than seeing an Apple or an IBM or somebody like that go under. So that asset class in general has a little bit more risk associated with it. But they were,
So when something like this happens, caution hurts them.
yeah, they tend to be the first ones that people want to get rid of out of their portfolio because they're a little more volatile. So while we like volatility sometimes when the market's going great, right, they'll go up a little bit more. But in tough times, they tend to go down a little bit more. So that spread between their highs and lows tends to be a lot bigger than, say, a Fortune 500 company. So again, small caps are kind of, we're kind of neutral with respect to those asset classes right now, but we're getting to sort of these valuation extremes. And again, everything in our game is kind of relative. You can say things are expensive or cheap. It's really relative to what else is out there, right? So right now, large caps, while we have the overweight there, they're probably the most expensive on a relative basis because again, the small and medium stuff got beat up pretty good back in the first quarter. So it's a lot cheaper, but there's good reason it might be a lot cheaper. They're going to struggle a little bit when things turn around and not be able to grow their earnings as fast. So from that perspective, again, we'll overweight and underweight these various asset classes, but right now we still think large and large growth is probably going to continue to dominate for the next couple of quarters. That could certainly change by the time we get together next time, but at least for now, that's kind of our best thinking as we wind down 2020. So again, the whole rest of this section, as you guys know, there's a lot of detail on why we like, US stocks more than others, why we are allocated and, we're positioned the way we are. But, suffice it to say, as we kind of look into our crystal ball and we wind down, obviously, the focus at the beginning of the year will be on those recounts in Georgia. And exactly, our best guess right now is that the Senate will stay Republican. Mr. Biden will stay president-elect and turn into president later in January. And again, as we talked about earlier before the meeting, that divide is really something I think the market likes. Because if there's one thing I can say with 100% certainty about the markets, they don't like uncertainty, right? So to the extent that we get a little gridlock and get a little balance there with the powers that be and the branches, you probably won't see as extreme an agenda on the Democratic side, or we won't see a lot of what was done over the last 4 or 5 years get repealed immediately. So we'll get sort of that balance, and that's really kind of what the three-headed monster is supposed to do, right? So again, the market likes that kind of certainty or the lack of uncertainty, and certainly that's one of the things, along with the viruses being announced, that really has driven the market here in November. So with that, let's talk about our piece of the portfolio and how we did in a little more detail. That's over on tab 2, starting on page 17. You see for the quarter, we were pretty much right on top of the policy benchmark there at 6% or 6.08. But we were still playing a little bit of catch up for the calendar year and fiscal year. But again, guys, that 9.26 fiscal year return for 12 months, that's just, and again, I never would have thought we would have seen that given the environment that we got. So very good quarter for the fixed income. Our piece bounced back pretty nicely, again, because of the overweight to those corporate bonds that did a little bit better and continue to do better. That really drove the performance of that piece. But in general, we're still underweight there. I won't spend a lot of time on page 18. That's just the cash flows. Again, we sort of upped the cash flows, I guess, in the middle of the year, Laura, was it? Or was it after the first quarter?
Yeah.
We kind of were at 25,000 a month for each portfolio, but as your plan continues to age, we have more and more retirees and more people coming out. I blame Roger a little.
I do.
Right, so that's why we had to increase those distributions. Yeah, you weren't in there too, right? Anyhow, but again, that's what these plans are designed to do, so, again, that's not an issue or a concern. A little more detail on performance. I won't spend a lot of time here, guys, only because, again, the most important number right there in the blue, but, again, some of the pieces that did pretty well, large cap growth for the last year, up almost 36%, 35.8. And that still wasn't as good as the benchmark. The benchmark was up 37.5. So again, that really kind of shows you why we did have a lot of exposure to those names that did very well. Almost impossible to overweight them.
You found whoever makes freezer,
Freezer.
Yeah, you can't find a
you
freezer.
cannot find that there's one freezer in Columbia County that I know of.
I looked over and found one in Home Depot with a dent in it. It's the only one they had.
That was it. Was
They
it a
had-
floor model?
They had a whole truckload come in or something like that.
Free County.
Yeah. You can't even order them online.
I was gonna say, what is it? You gotta have a holiday bird in the freezer, right? Or hunting season's coming up too.
I got people around here that pick their peas and stuff and put them up.
Yeah, you can't even order them online.
Yeah, that's weird. I had not heard that.
I think I'll put mine up for sale
Yeah, I'm not afraid to hear, right?
Evidently, they closed down those plants for a while.
When they went to making these face masks.
then.
Oh, it's more profitable? Yeah, that kind of makes sense.
More profitable, they just quit making, so it was basically ordered to cut down and start making food related items.
Well, and there may be, this is one good example, but that kind of dovetails off of what Peter was saying earlier. I mean, again, we're gonna see a lot of pricing pressure on a lot of products in 2021 and beyond as we start to
I think
recover.
there's gonna be a lot of inflation in it, so I don't think building material, and I have some food when the gentleman talking on TV and news that day. But the reason I was up because of the cheap building products.
Oh, my God.
He hasn't been
I
there.
don't know where he lives, but it's not here in the southeast for sure.
I can't remember who he was, but he was big dog with that.
Some of the plants did shut down over the, some of the summer, so they got a little bit behind. And then the housing boom took off and, there was high demand for all
Yeah,
those
but that's
appliances.
what's gonna do to these houses, and if they can't get a freezer, they ain't gonna be able to finish that house. So
Right.
people gonna have to bring what they got with them.
It'll take a little bit longer, that's for sure. So, okay, guys, basically pages 19 through 22 really go into the nitty gritty of the performance of the fund. Again, suffice it to say, very pleased, still playing a little catch up versus our benchmarks, but I was very, very pleased with how well the stock and bond portfolio did over the last year. Just wanted to touch a little bit on a couple of changes that we made this most recent quarter. And most of them are on the bond side, but we did have one equity change. Under equities, under international, consistent with our thought that growth should continue to do a little bit better. We exited the position in the DFA International Equity Fund in favor of the JOHCM International. And again, they have a little bit more of a growth bias to the stocks that they buy. So that's kind of consistent with our outlook. And then on the bond side, most of the changes were done on the bond side, and they were really in relation to the Fed lowering rates back to zero. We no longer feel that we need to be more defensive, so we eliminated both of the short-term positions that we had in our bond portfolio. Again, the difference between a 2-year bond and a 5-year bond, you're not getting compensated anything. So we decided that we were going to eliminate those. And then consistent with us kind of overweighting the corporate sector and underweight mortgages, we eliminated double line total return funds. And really, the sale of all 3 of those funds, we kind of plowed back into the total return funds that are a little more broadly diversified, have more corporate exposure. So just a couple of small tweaks to the portfolio this quarter, but again, we think that better positions the bond portfolio to take advantage of what we think is going to be a pretty rough environment for bond managers going forward. So as always, guys, the rest of my book goes in a lot more detail. We got all the fund fact sheets for every fund that we use. So if you ever get really bored, you can see where your intermediate bond managers, how much corporate exposure he has. But as always, I also include the 1-page or the 3-page handout. It kind of combines both the River Place and the SunTrust portfolios, give you an idea how we get combined. So again, for the year, up a little more than 8% or 8.29. Plays a little bit of catch up versus that benchmark, but still good solid performance out of the total portfolio, up a little more than 5% this quarter. So good solid absolute numbers as well. And as Peter indicated, both portfolios are off to a great start the first 6 weeks here. So to the extent that'll keep Mr. Tierney or whoever you're at, I believe he's still your actuary. Yeah. Keep him happy for one more year. It certainly should keep the city and their contribution levels the same. Because most plans, I think you guys have a 4-year smoothing, correct? I'm not sure.
A 4-year what?
4-year smoothing where they take that investment return and sort of average it over.
Yeah, I don't remember whether it's 3 or 4, but
Yeah,
but there is a
4 or 5.
smoothing.
It's multiple.
Yeah.
Yes, and that kind of keeps the city contribution from spiking in any one year, right? So they sort of smooth out that investment return. And there's obviously a lot of other factors that go into the numbers that the city has to put in, but investment return tends to be one of the bigger ones. So to the extent that did very well this year, and we're not dropping off a really great year, I think we should be in pretty darn good shape from their perspective as well. That normal contribution shouldn't fluctuate too much this year for sure. At least not nearly as much as I thought it could have a couple of quarters ago.
Yeah, but you look at those 5 and 10-year numbers and even inception to date numbers, and you've been well ahead of your actuarial
Yeah,
requirements.
we certainly got a cushion for sure.
And since this plan is not including new members, should have been pretty easy on the cities, on their budget.
Okay. So any questions or comments on performance or what crystal ball looks like for the rest of the year?
What is it for this time?
Again, probably much of the same. We're gonna see a lot of this volatility, until we get a vaccine. We get past, the inauguration and get a clearer picture of exactly what the political landscape, I think, will be a little bit more, in focus on the first half of next year. And that's gonna obviously provide opportunities and be headwinds for certain industries and companies.
But yeah, next meeting, you guys will get a little bit more feel about.
Might have a little bit more flavor, but And until he gets in there, he's not really saying a whole heck of a lot. And you know how politicians are, they promise you everything, but let's see what they actually implement.
Good deal. Thank
Thank
you,
you,
sir.
guys.
Appreciate it.
We got more confidence than you would like.
I don't.
Well, I've been doing this for over 40 years and I've seen all different presidents of different administrations. And I'll be honest with you, it means a lot less than most people think it means.
That's good to know.
Right.
And we all get up, we go to work, companies find a way of making changes, adapting to the environment, make money.
And
And
that's what the rules are.
that's the great part about America.
So next thing on the agenda is open discussions. Anybody have anything they want to discuss?
Yeah.
Next meeting date, if we stick to our schedule, you guys like Thursdays or Tuesdays?
I prefer Thursday, to be honest with you.
Okay, well, you're coming from out of town, so we'll stick with, it doesn't matter to me, my schedule all over the place. February 11th, we stayed on Thursday. It depends on the economy. Right now, I'm working 7 days a week to make all I can, pay everything off.
So we're good with, you guys good with February 11th?
Yeah, works for me.
Okay, what time? 7:11.
Well, again, these guys come for,
Both work for me, or at least work for me.
Peter, do you prefer 10 a.m. or 11 a.m.?
No, 10 is just fine.
Okay, 10 a.m. it is.
February 11th. I will put it in here.
have a motion to adjourn.
Second.
Adjourn.
I think y'all done pretty good.
We're going next.
No, I'm like, wow, that's good.
I tell you, I was the same way when we started putting these numbers together, I was like, holy crap.
We gotta find, they find a way of getting those out.
Yeah, I'm gonna get with Jim Milton and, if I have to come up here for open enrollment or set something up. Just set it
Yeah,
up.
I run mine, because mine didn't come to the meeting.
Mhm.
Yeah, I bet you could have.
He said, yeah.
Tomorrow.
See, I didn't know they weren't distributing it. I sent it to Audrey and I,
Do you foresee any changes to the distribution?
what'd you say?
Do you see any do you foresee any changes to the monthly distribution?
No, we switched it to 60,000 just because that was kind of what was coming out.
So 30 each?
No, it's 60 each. It
Well,
went from 25 each to 60 each.
Oh, I didn't realize it
probably
was that
just
big.
took a big hit on drop with Marvin.
Yeah, that's kind of a one-time
And then you
thing.
got Steve coming up.
Mhm.
You got Steve coming up in May. There's a few more, I call heavy hitter drops coming out in the next several months.
We've had those.
One of them's already come out, and Marvin's already.
Well, we have plenty, we have plenty of
Last fiscal year.
Yeah, the one-timers aren't that big a deal. It's more the regular recurring monthly distributions that are a bigger deal, at least from our
Yeah.
perspective. Because those are the ones where Laura has to panic.
Well,
We don't
and
want to
they're-
withdraw the account, so we got to start shuffling money from here and there and here and there. So,
And once Steve comes out, he told me that he's leaving in May, I think he said. Once he, the ones, it's gonna go, there's no more big, it's not,
it won't be big.
they're all going to be less.
Both of them going into drop too?
No, a lot of them probably won't do drop either.
So then we'll
Sarah, I was just talking to
continue on
Terry,
it.
she said it's gonna be 6 years before she can even get into it. She's only 40.
Who?
Terry Phillips.
She's only 49.
She's not dreaming anymore.
That's not what you want to say, that's right. Women like it the other way.
But anyway, yeah, so like Thomas Henry, he's not in draw. He will be. He's-
He'll have to wait till he's 55.